Welcome to the Now and Beyond podcast, hosted by Ryan Canfield, founder and president of Victus Wealth Management. Whether you're seeking financial freedom, investment insights, or simply looking to optimize your lifestyle, tune in for conversations that empower you to achieve a balance between enjoying the present and ensuring a resilient financial future. Welcome to a podcast where the art of living well today intersects with the science of planning for a brighter tomorrow.
Hey everybody, welcome to the Now and Beyond podcast, the podcast that helps you balance living your best life today while planning for your financial future. I am your host, Ryan Canfield, founder and president of Victus Wealth Management, and today we're diving into the 5 financial mistakes to avoid before age 45. These are mistakes that I have seen clients make over the years and mistakes that I have helped them overcome as their financial advisor. Whether you're just starting your career, raising young children, or approaching midlife, these common pitfalls can have a significant impact on your financial well-being. In this episode, we're going to explore how things like neglecting emergency savings, buying too much of a house, not having enough or not having any insurance coverage, prioritizing saving for your kids' college instead of your own retirement, and failing to invest for growth can derail your financial plan and hurt you in the future. We'll not only identify these issues, but also provide practical strategies to help you avoid them or course correct if you've already fallen into these traps. My goal is to empower you with the knowledge and tools to help you make well-informed decisions that allow you to experience life today while also saving for the future. Now let's dive into the financial mistakes that many families make before age 45. These pitfalls can have significant long-term consequences, but with awareness and proper planning, they can be avoided or corrected. The first mistake that I see is people neglecting emergency savings. Many families underestimate the importance of having a financial safety net, leaving them vulnerable to unexpected expenses or income disruptions. According to a recent study by the Federal Reserve, nearly 40% of Americans would struggle to cover a $400 emergency expense. 40%. That's crazy. This lack of preparedness can lead to you becoming dependent on high-interest credit cards or loans, creating a cycle of debt that's extremely difficult to break. So what can we do? How can we make sure that we are not part of that 40% statistic? We have got to aim to build an emergency fund that covers at least 3 to 6 months of living expenses. Now, this number really depends on a lot of different factors. For example, if you have a very secure job with steady income, you might be able to get away with having only 3 months of living expenses. But if you have a job where your income fluctuates, or maybe you're based on sales and commission, you might need to aim for more than 6 months of living expenses. And when you start to think about that number that you need in your emergency fund account, I get it. It can be intimidating, but you don't need to worry. You can start small by automatically transferring a portion of each paycheck into a dedicated savings account and gradually increase the amount as your financial situation improves. Another piece of advice is to examine your cash flow for 3 months and see what you can cut out. If you're anything like me, you probably have a bunch of streaming subscription services to watch all of your different shows and sports. Are there any that you don't actually use? And if there is, cancel, and then take that monthly cost and allocate it to your emergency fund. You will truly be amazed at how quick this can add up. All right, moving on. Overspending on housing is the second common mistake that I see. While a comfortable home is essential, allocating too much of your income to housing costs can strain your budget and, not to mention, limit your ability to save for other important goals. There's some financial experts that generally recommend spending no more than 28 to 30% of your gross income on housing expenses, which include mortgage or rent, property taxes, and insurance. And if you find yourself exceeding this threshold, you basically have three options. Consider downsizing your home, refinance your mortgage if interest rates are favorable, or explore ways to increase your income. Now, a quick story. So when my wife and I was looking to purchase our first home, I remember we were pre-approved for an $800,000 mortgage, which was absolutely insane at the time. There was no way that we could afford that monthly payment. We were both in the beginning of our careers. We had also just found out that we were expecting our first child. And I've had clients in this same situation, but unfortunately, they bought the house before they were working with me. And they were house poor. And after just a few months, not only were they struggling to afford the monthly mortgage, but the utilities were eating away most of their cash flow as well. And I remember when I went to go meet them for the first time, I walked into their absolutely gorgeous house and noticed that most of it was missing furniture. Guess what? They couldn't afford to furnish the house. And the furniture that they did have, it all went on credit cards that were now maxed out. And now the monthly credit card payments were too much for them. Do you see how this all can snowball? The third mistake that I see is it having inadequate or no insurance coverage. Many families underestimate their insurance needs, or they opt for the minimal coverage because they want to save on the premiums. However, this can be a costly error if unexpected events occur. For instance, there was a study by LIMRA that found that 41% of Americans have absolutely no life insurance, leaving their families financially vulnerable in case of a tragedy happening. Now, I know what you might be thinking. I'm too young for life insurance, or nothing is going to happen to me. Well, let me tell you a quick story about a client of mine. I have this couple that started working with me years and years ago when they were both only 26 years old. The husband worked for a local engineering firm, and the wife had just become a stay-at-home mother. They had one child at the time, with hopes to have at least one more in the coming years. Now, let's fast forward 5 years. And the husband was driving home from work, and unfortunately, he was killed by a drunk driver. The wife and I met 2 weeks after he passed away, and the first thing out of her mouth was that she did not want to go back to work. How can we make sure she didn't have to go back to work? What can we do? She wanted to continue to stay home to raise their now 2 children. And I won't go into too much of the details, but because I suggested 5 years ago that they both get life insurance, and yes, stay-at-home parents need life insurance too, I was able to create a plan for her to continue to stay home and raise the kids until they were in school full-time. At the time of that insurance conversation, none of us, nobody could have predicted the husband would tragically pass away. But we had to be prepared for those unexpected events. Similarly, inadequate health, disability, or property insurance can lead to devastation as well. To address this, you need to regularly review your insurance policies with a qualified professional to ensure you have the appropriate coverage for your family's needs. You want to consider factors like your income, your debts, your future expenses, and potential risks when determining coverage levels. While it may seem like an additional expense now, comprehensive insurance coverage can provide invaluable peace of mind and financial protection for your family's future. The fourth mistake I see is people prioritizing their kids' college savings over their own retirement. Now, I'm not going to tell you not to save for your kids' college. If that is extremely important to you, then by all means do it. But you need to make sure that you and your spouse are on the same page. I have seen multiple times where one spouse wants to prioritize saving for retirement and the other spouse wants to pay for 100% of the kid's college education. And a lot of times, they're not in a position that they can currently do both. While providing for your children's education is a noble goal, I believe it shouldn't come at the expense of your own financial security. Remember, there are loans, scholarships, and other options available for college, but you can't borrow or take out a loan or get a scholarship for your retirement. A study by T. Rowe Price found that 74% of parents prioritize college savings over retirement, which potentially jeopardizes their financial future. To strike a balance, consider maximizing your retirement contributions first, then allocating any additional savings towards the college funds. You can explore tax-advantaged options like 529 plans for college savings, but don't neglect your 401k or your IRA contributions. By making sure you're saving for your own financial future, you could be in a better position to help your children in the long run, whether through education expenses or other forms of support. I've seen some families that will save extra into the retirement account, so that way when the child graduates from college, they're able to start paying some of the student loans on behalf of their child. The final mistake that I'm going to cover today is failing to invest for growth. Many families, especially those in their 30s and early 40s, play it too safe with their investments, missing out on potential long-term gains. I could name a lot of reasons why they play it too safe, but one of the main reasons I have seen is because their parents tell them that they have to. Listen, our parents want what is best for us. They truly do. They also think because their own personal investments might be more conservative in nature, that our investments should be as well. Therefore, we tend to listen to them. We need to think about how our situation is significantly different than our parents. They could be pulling money from their investments on a monthly basis, whereas we're not. They are also at an age where they might not feel like they have the time to weather extreme volatility, but our generation does. And while it's natural to be cautious, especially after experiencing market volatility, being too conservative can hinder your wealth accumulation. Historical data has shown that despite short-term fluctuations, the stock market has consistently provided higher returns than more conservative investments over long periods. And to address this, consider diversifying your portfolio with a mix of stocks, bonds, and other assets appropriate for your age and your risk tolerance. You need to regularly review and rebalance your investments and don't shy away from growth-oriented options, particularly if you have a longer time horizon before retirement. Also, a little reminder, make sure your employer's retirement plan is actually being invested as you contribute to it. There have been way too many times that I have reviewed statements and noticed that while the client is contributing each paycheck to their plan, the money is actually sitting in cash. Let me repeat that. The money is sitting in cash. Can you imagine what would happen if you didn't catch this? The impact would be large. So make sure the money is actually being invested. Remember, the power of compound interest works best when you give your investments time to grow. By starting early and maintaining a balanced, growth-focused approach, you can potentially boost your long-term financial prospects. So as we wrap up today's episode, let's recap the 5 critical mistakes that families often make before age 45. Not having an emergency fund, overspending on their house, having no or not enough insurance coverage, prioritizing their kids' college savings over their own retirement, and finally, failing to invest for growth. By addressing these issues head on, you can significantly improve your family's financial well-being and set yourselves up for a better future. Remember, The key to financial success lies in finding the right balance between enjoying life today and planning for tomorrow. Start by building that emergency fund, even if it's just a small amount each month. Be mindful of your housing costs and ensure they don't overshadow other financial priorities that you and your spouse might have. Review your insurance coverage regularly to protect your family from unexpected setbacks. While saving for your child's education is important, don't forget to prioritize your retirement savings. Finally, don't shy away from growth-oriented investments that can help build that long-term wealth. I hope this episode has provided you with valuable insights and actionable strategies to avoid these common pitfalls. I encourage you to take a moment to reflect on your own financial situation and identify areas where you can make positive changes. Remember, it's never too late to course correct and set yourself on the path to financial success. If you have any questions or if there's topics that you'd like me to cover in future episodes, please feel free to reach out to me. You can email me at rcanfield@victuswealth.com. I'm here to help you navigate this complex world of personal finance and find that sweet spot between living well now while planning for the future.
The opinions voiced in this podcast are for general information only and are not intended to provide specific advice or recommendations for any individual. To determine which strategies or investments may be suitable for you, consult the appropriate qualified professional prior to making a decision. Securities and advisory services offered through LPL Financial, a registered investment advisor. Member FINRA SIPC.